Hello and welcome to this session, Learning Outcome, LO3, Understand how capital is structured in a business. Today, we'll explore how businesses decide their financial backbone balancing equity, debt, and retained earnings, and see how these choices impact financial health and growth. Capital structure is the mix of equity, debt, and retained earnings a business uses. This balance affects the cost of capital and financial risk. Equity involves ownership, while debt requires repayment with interest. Retained earnings are profits reinvested into the business. Each component has distinct advantages and disadvantages. Equity capital comes from owners or shareholders investing in the business. Shareholders gain a claim on future profits through dividends. It includes ordinary shares, preference shares, and retained earnings. Equity does not require repayment but dilutes ownership. Dividends are expected if profits are strong. Debt capital involves borrowing money that must be repaid with interest. It includes bank loans, bonds, and debentures. Short-term debt covers immediate needs, while long-term debt supports major investments. Debt does not dilute ownership but adds financial risk. Interest on debt is often tax-deductible. Retained earnings are profits kept in the business rather than paid as dividends. They fund reinvestment in assets, research, and expansion. No interest or control loss occurs with retained earnings. However, they may be limited and create tension with shareholders. Retained earnings are a key internal funding source. The capital structure impacts the cost of capital, financial risk, and control. A high debt structure increases repayment pressure. High equity structures may reduce risk but weaken owner control. Flexibility in raising funds is crucial. Different approaches balance risk and return based on business strategy. Different business types have varied capital structures. Sole traders use personal funds, while partnerships rely on partner contributions. Private companies mix shares, loans, and retained earnings. Public companies raise equity through shares and bonds. Charities depend on grants and donations. Capital structure is influenced by internal and external factors. Types of securities, gearing levels, and market conditions play roles. Business size, profitability, and income stability are crucial. Control considerations and investor preferences matter. Market conditions affect debt and equity attractiveness. Gearing measures the proportion of debt in a company's capital. High gearing means more debt, increasing financial risk, but boosting returns. Low gearing indicates more equity, reducing risk but increasing capital costs. Gearing affects creditworthiness and capital raising ability. It's a key consideration in financial strategy. Undercapitalization occurs when a business lacks sufficient permanent capital. It results in high earnings compared to capital employed. This can lead to asset overworking and delayed payments. Common causes include starting with little equity or excessive short-term borrowing. Undercapitalization strains growth potential. Overcapitalization happens when a business raises more capital than needed. It results in low returns and reduced profitability. Causes include high promotion costs and poor investment decisions. Overcapitalization affects shareholder confidence and market value. It leads to idle capital and inefficient operations. Both undercapitalization and overcapitalization affect financial management. Undercapitalization leads to short-term focus and limited flexibility. Overcapitalization requires cost-cutting and restructuring. Each condition influences shareholder returns and business strategy. Finding the right balance is crucial for stability. Undercapitalization offers high dividends initially, but risks long-term growth. Overcapitalization leads to low or no dividends, affecting confidence. Shareholders may push for changes in leadership or strategy. Both conditions impact market value and investor trust. Balancing capital structure is key for shareholder satisfaction. Undercapitalization limits expansion and investment capacity. Overcapitalization results in idle capital and reduced efficiency. Both conditions affect long-term strategic planning. Operational constraints may arise, impacting competitiveness. Efficient capital use supports sustainable business operations. Undercapitalization can lead to market price inflation. Overcapitalization may result in job insecurity and reduced community investment. Both conditions attract scrutiny from regulators and tax authorities. Public perception influences business reputation and market position. A balanced capital structure supports positive public impact. Addressing undercapitalization involves raising additional capital. Adjusting the capital structure to include more equity or debt helps. Balancing short-term gains with long-term investment is crucial. Effective governance and cost control support sustainable growth. Strategic planning is essential to manage capital efficiently. Overcapitalization requires cost-cutting and restructuring efforts. Businesses may need to buy back shares or refinance debt. Reducing idle capital and improving efficiency are priorities. Strategic mergers or downsizing might be necessary. Effective capital management restores investor confidence and operational health. A well-balanced capital structure aligns with business goals and market conditions. It reduces costs, maintains liquidity, and supports long-term success. Balancing equity, debt, and retained earnings is key. Flexibility and strategic planning ensure financial stability. The right mix enhances growth potential and investor trust. The right capital structure is dynamic, adapting to changing needs and conditions. Undercapitalization and overcapitalization distort business performance. A balanced approach ensures financial sustainability and market competitiveness. Realistic assessments of needs and capacity are essential. Effective capital management builds investor trust and long-term success. In conclusion, we have learned that capital structure is a fundamental aspect of business finance. Carefully balancing equity, debt, and retained earnings is essential for maintaining financial health. A strategic approach not only supports sustainable growth, but also builds investor confidence. Understanding these principles helps in designing more efficient and effective financial systems. If you'd like to know more or have any questions, you can reach us on 074-8436-1688. Our team is here to help. Thank you, and we'll see you at the next session.